Good evening, everyone. To be looking at business management and finance (BMF). And our topic today will be Introduction to Financial Management. This topic is wide, so the content of this topics is one. We'll be looking at financial management. What is financial management? It will look at the financial objectives. We will look at stakeholders and the financial management framework. Then five, we'll look at the financial market. The financial market talking about the the primary and the secondary market, the money market, and the rest. Then six, we will now look at money market on its own. Then seven, we'll look at money market instrument. What are the instruments that can be traded on a money market? Eight, we'll look at the nature of cash management. Then nine, we'll look at cash budget and cash flow forecast. But today we'll look at financial management, financial objective stakeholders and stakeholders. Now, the introduction? Business business concern need finance. That is, all business needs finance. Times all business need money to start the business and to run the business to meet their requirements in the economic world. Any kind of business activity depends on the finance. Hence, it is called as lifeblood of business organization. Now I say finance, which is finance. Some people also call finance as money, fund, capital. Is the heart blood. So is the lifeblood of an organization. So no organization can run without fund, without money, without finance. So finance is the blood of any, it's lifeblood of any organization. Now, what is the meaning of finance you're talking about? What is the meaning of finance? Finance can be defined as the art and science of managing money. That means finance is the art of managing money. Then that is the way we manage our money in the business organization. It includes financial service and financial instruments. Finance also is referred as the provision of money at the time when it is needed. That means finance means you have to provide the money when it is needed. Finance function is the procedures of funds and their effective utilization in business concern. That means as we are saying finance, when we say finance, when you hear finance in any news, business news, organization, so finance means how you can provide the money, how you can source for the money. That is finance. Now let's look at definition of business finance. What is business finance? Business finance. So according to Wheeler, business finance is that business activity which concerns with the acquisition and conversion of capital funds in meeting financial needs and overall objective of a business enterprise. Okay, corporate finance. What is corporate finance? Corporate finance is concerned with budgeting, financial forecasting, cash management, credit administration, investment analysis, and fund procurement of the business concern. And the business concern need to adopt modern technology and application suitable to the global environment. So corporate finance, because we have business finance, we have corporate finance. So you might ask an example, what is corporate finance? So it's concerned with budgeting. So corporate finance talk about budgeting, financial forecasting, cash management, credit administration, investment analysis, and fund procurement of the business concern. So we have two major types of finance. So types of finance. So we have the private finance and the public finance. Finance is one of the important and integral parts of the business concern. Hence, it plays a major role in every part of the business or the business activity. It is used in all the area of the activities under the different names. Finance can be classified into two major parts. So we have two major parts of finance. We have private finance and what and public finance. What is private finance is concerned with the individual, firms, businesses, or corporate financial activities to meet the requirement. So it's a private finance. We're talking about finance of any individual, companies, firms, etc., other than the government. So when we say public is talking about government. When we say public, it's talking about government, which concern with the revenue and distribution of government, such as the central government, which is the federal government, the state government, and the semi government, which or you can say the local government in terms of Nigeria. So the three tiers of government. So when we say public finance, I talk about the revenue and expenditures of government, be it the federal, the state, and the local government, and the local government, and the local government. Now, definition of financial management. So, what is financial management in itself? We've just go around finance and we'll now come back to the main issue of the main topic of today, financial management. Now, financial management is an integral part of overall management. So it's an integral part of overall management. And financial management integrates all management, be it accounting, be it manual accounting, be it financial accounting, or be it all management activity or management of an organization. It is concerned with the duties of the financial managers in the business firm. Management is about planning. So, what is financial management itself? Is the planning and the controlling the financial affairs of an organization in order to ensure that the organization achieve its objective. Now, the financial management is the major talks about the major objective of an organization. So they try to integrate or match all the function of an organization to achieve its major objective. This involves decisions about financial management talks about decision about one, how much finance the business need for its day-to-day operation and long-term investment project. That means the financial management talk about day-to-day finance operation, that is the day-to-day operation of an organization, including the long-term project. Where where the finance should be obtained from through equity capital, debt capital, or short-term finance. So financial management is talking about, okay, how can a company source debt, or how can a company source for fund, or how can a company source for finance? So is it through equity, that is through issuing a new shares in the Nigerian Stock Exchange or any recognized stock exchange, or through debt, that means through debenture, or through short-term finance, that means maybe through negotiating credit supply from their debtors, sorry, from their suppliers, or through bank overdraft. These are short-term finance. Number three, what should be the capital structure of the organization? That is balance between equity and debt capital. So financial management also talk about the capital structure, because companies or any organization must ascertain how they want their company to look like. Is it or equity. That means a company that is being built or developed or established with pure equity. That means no debt. They don't borrow money from bank or you not use any debenture or debt and equity they use to compute start up the business, which is the equity of the business can be through debt and equity. So this is a topic on its own. Maybe in our last stage, the professional stage, we will treat capital structure. We understand the meaning of capital structure very well. Three, investing short-term cash surplus. That is the major. That's one of the objective of or the function of um financial managers. They have to invest short-term fund. Now the difference between financial management accounting, and financial accounting. So let's let's look at these three accounting functions. Now financial management accounting, and financial accounting. Now financial management. What is financial management? Has a strong accounting element, and in large organization, it it is usual to find that professional accountants are involved in financial accounting and financial management. So financial management integrate financial accounting and management accounting function together. But financial accounting is concerned primarily with maintaining the statement of account, which is the ledger. Now, financial accounting and talks about the ledger, the accounting is what is the ledger, the account, and prepare financial statement for shareholders and external users of financial information. That means financial accounting focuses on the ledger and preparation of financial statement. So they did not go beyond that. They did not invest surplus cash. So all they wanted, what financial accounting is all about, is to prepare the financial statement. But management accountants provide information, mainly financial but also non-financial, to assist management with making decisions about planning, controlling the resources of the organization. Management accountants provide information for the organizations, both financial and non-financial, for planning and controlling of the resources of the organization. So many accountants also talked about how to manage or ascertain cost, how to know the cost of a product, how to ascertain the price of a product. So that is another function of management accountant. Now, another thing is that financial accounting is concerned largely with reporting reporting externally about historical performance. Now, financial accounting report on historical performance. That means financial accounting, what they what they do is that what they do is that all their reports, all their function is all about historical performance. So they review the financial statement and talks about the previous accounts of the company. Now, management accounting is concerned with internal reporting to decision makers with the organization. So management accounting is from the word management report. So their major function, the management accounting does not interact with an external party at all, unlike financial accountant. So financial accountant report is used by external body, but management accounting report is normally used by the internal management, which is the board of directors. Management accountant information may be either historical or forward-looking in nature. So management accounting does not consider historical figures or details or information. Their information is also for future use. Financial management. Financial management is concerned mainly with managing the finance of an organization, raising finance, putting it to efficient and effective use by investing in. So financial management function that they concern mainly with mainly with managing the finance of organization. That is their own issue is to manage fund, manage cash, manage money for an organization. So what they do, they manage fund. They want to know, okay, this, okay, is there cash for you to pay salary? Is there cash for you to pay our operating expenses? So that is the function of management accountant. So many accountant is they want to know if there is surplus or if there is shortage or if there is available cash to pay s- staff and run the day-to-day operation of an organization. Financial managers have a management function as well as advisory function to senior management. Now, managers, most of their function is advisory, they advise. Unlike financial accountant, any of the advice is based on historical information, based on information given to management. But financial managers, they they give advice. There is they always their major work apart from managing finance is to give advice, their advisory function on if to for merger and acquisition. If the company wants to merge or wants to acquire other business, they are the one they give advice to the management. Now let's look at financial engineering. What is financial engineering? So financial engineering, when you hear this financial engineering, we're not talking about engineering or mechanical engineering on this. This is financial engineering. Now, the major of financial engineering is purely finance. It's pure finance. Is more of asset secularization. What is how is asset secularization? That is the more of how to convert different assets, different instruments in order to be traded in a recognized exchange. Now, financial engineering refers to the creation of a new securities by unbonding. So that means financial engineering creates new security. It creates new security other than equity, other than debt, other than futures, other than options. So they create new equity. They can use mortgage to create. They can use pension fund to create security whereby people will purchase it and be traded on a recognized stock exchange. So how do they create it? Because by unbonding, that's bringing up or allocating the cash flows from one security to create a several new securities, or by bonding, combining Bun- bundling mean combining more than one security into a composite security. That is the financial engineering. These people they 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 think, they look at securities, they can use your bond and convert it to different security where people can purchase and buy them. Now, financial engineering. Financial engineering involves the use of mathematical techniques to solve financial problems. Tools and knowledge are drawn from the field of statistics, economics, and computer science and applied mathematics. So this financial engineering, they, they, they are so good in statistics, economics, computer science, and the rest. So they use this function in order to arrive at the financial engineering. Now, what is the objective of financial management? Objective of financial management. Now, we have three major objectives of financial management. We have three major objectives of financial management. Hence, the financial managers must determine the basic objective of the financial management. The objective of financial management may be broadly divided into three parts. So they have three major parts. Mm. But actually, three major parts, two are very, very important. So we should be able to understand these two: profit maximization, wealth maximization, and growth in earnings per share and growth in earnings per share. So so let's let's look at growth in earnings per share. Let's explain growth in earnings per share. Growth in earnings per share. Growth in earnings. Growth in earnings per share. Growth in earnings per share. So growth in earnings per share. Let's look at growth in earnings per share. Now, the the most the most common measure of profit per share is earnings per share or EPS. A financial objective might be to increase the earnings per share each year and possibly to grow EPS by a target amount each year for the next few years. So when we say growth in earnings per share, talk about for you to get growth in earnings per share, you must increase your profit annually in order to increase your earnings per share. There will be more profits to pay. The reason why it's an objective of financial managers is that so that there will be more dividend to pay and more dividend per share if there is profit, because once there is a huge profit, there will be a tendency that the company will pay dividend. That means for a company that do pay dividend regularly, there will be more retained profit to invest with the intention of increasing earnings per share in the future. Yes, for company want to retain, they want to acquire more business, they want to expand, they have to retain some profit. That profit what they will use to invest. So that is why growth in earnings per share is one of the objective of a financial manager. Now, the another objective is that profit maximization. Main aim of any kind of economic activity is earning profit. That means the major objective, the main aim is what? Is to make profits of a company is to make profits. So, but that is not the in terms of financial management, it's not only the major aim of a company. It's also to maximize wealth. But before you can maximize wealth, you must maximize profit. A business concern is also functioning mainly for the purpose of any profit. So the reason you are opening a business is for any profit. It's not for charity. It's not for a social investment unlike government. So any company you open, any company you run is majorly to make profit. So when you don't make profit, so the business is not profitable. So you have to leave the business and go to and open a new business that will be more profitable. So profit is the measuring techniques to understand the business efficiency of the concern. Profit is also the traditional and the narrow approach, which aims at maximize the profit of the concerned organization. Now, profit maximization consists of the following importance. Why is it important we should maximize profit? One, profit profit maximization is also called as cash cash cashing per shares. Cashing per cashing per shares. That is cash per shares maximization. It leads to maximize the business operation for profit maximization. So to it to maximize profit, it's also called cashing per share. Another word for profit maximization is what? Cashing per share. Ultimate aim of business concern is any profit. Hence, It considers all the possible ways to increase the profitability of the concern. Profit is the parameter of measuring the efficiency of the business concern. So it shows the entire position of the business. Profit maximization, profit maximization objective helps to reduce the risk of the business. So when you try to maximize profit, you will reduce the risk of the business. That is that the company might liquidate in the future. So the favorable argument for profit maximization. What is the favorable argument for profit maximization? We'll say one, main aim is earning profit. That is the main aim of a business is to earn profit. Two, profit is the parameter of a business operation. Profit reduce risk of a business. Profit is the main source of finance. Yes, from profit that's where you have more source, more finance you use to run a business. So if you make profit this year, the profit you made this year, you use to run your business. So or increase your business. So profitability meets the social need also. Unfavorable argument for profit maximization. Why? What is the unfavorable argument for profit maximization? Profit maximization leads to exploiting workers and consumers. Yes, because the major aim of business is to make profit. In order to make profit, they may lead it make profit in the detriment of their workers and consumers by reducing the pay of workers. So because they want to make profit, they can lay off staff. So by doing that, they are doing making profit in the detriment of workers. Where some company using the detriment of consumers, they will not give them a quality product because quality is tantamount to what? Quantity. So that means the quantity of materials they will use to make a quality product might increase, or the value they will incur to make a quality product might increase. So they might want to reduce quality in order to make profit. Profit organization creates immoral practices such as corrupt practices, unfair trade practices. Yes, because profit maximization, if you look at profit maximization, what does it that it brings immoral practices. That means so company will go beyond their ethics in order to make profit. Why some? What would they do? Some will do child trafficking. They will employ underage to work for them. Not is not to not to pay them the appropriate salary. So this is an immoral practices. Some will also go to some some company will also go to drug trafficking just to make profit. So profit maximization objectively to inequalities among stakeholders such as consumers, suppliers, and the rest. Wealth maximization. So wealth maximization is one of the modern approach. Profit maximization is a traditional approach, but the modern approach now is wealth maximization. That is in financial management now. The major aim of a company is to maximize wealth. Is the modern approach, which involve latest innovations and improvement in the field of the business concern. The term wealth means shareholders' wealth. So when you say it means shareholders' wealth or the wealth of the persons who's those who are involved in the business concern. Wealth maximization is also known as value maximization or net present worth maximization. The objective is an universally accepted concept in the field of the business. Favorable argument for wealth maximization. Wealth maximization is superior to the profit maximization because the main aim of a business is concerned is under this concept is to improve value. So is to improve value, is not just to make profit. You have to improve value. You have to improve value of shareholders. Wealth maximization concerns the comparison of the value to cost associated with the business concern. Total value detected from the total costs incurred for the business operations. Waste management concern both time and risk of the business concern. Waste management provide efficiency allocation of resources. What is unfavorable arguments for waste management? Waste management lead to pres- waste management lead to prescriptive idea of the business concern, but it may not be suitable for present day business. Waste management is nothing. It is also profit maximization. It is indirect name of profit maximization. Yes, you just a modern name gives a profit because you cannot maximize wealth if you don't maximize profit. So waste management creates ownership management controversy. So it's able to differentiate management from the ownership. So there is a problem. So the no, so we can also read the four unfavorable argument and the fifth, then the sixth. The sixth said waste management can be activated only with the help of the profitable business of the business concerned. Now, the other desirable corporate objective include the following. So, apart from the three major corporate objective, there is also other ones, which is the welfare of employees. You have to ensure the welfare of employees is an objective of the financial management. The welfare of management, the welfare of the society as a whole, yes, and the welfare of service. That means, sorry, the provision of service. The provision of what? Of service. And the provision of service is also objective um objective of the financial managers. Then the fifth is investment in new products and development of research and development. So the third subtopic of under this broad topic is stakeholders. Um, as long as we are writing this course, uh, BMF, we must know the meaning of stakeholders. Who are stakeholders? Stakeholders are different from shareholders. Stakeholders are any individuals, companies, government who has interest in the activity or performance of a company. So anybody, be it individual, be it company, be it government, anybody that have interest, as long as they have interest, like government has interest in just to collect their tax. So that's why they are stakeholders. Individuals who have interest, be it the employee for salary purpose. So everybody together is called stakeholders. So what is stakeholders theory? Stakeholders theory is a theory of organizational management and business ethics that accounts for multiple constituencies impacted by business entities like employees, suppliers, local communities, creditors, and others. It addresses morals and values in managing an organization, such as those related to corporate social responsibilities, market economy, and social contract theory. So stakeholders' objective is usually to group stakeholders into categories, with each category having its own interest and concern. The main categories of stakeholders group in a company are the following. So we have so many stakeholders. So if in that's an exam, list stakeholders and their interest, or list stakeholders and what their interest in the company. So we should know stakeholders. Everybody that have interest in the business is a stakeholder. So one of them is employees and managers. Employees and managers, they are also stakeholders. What is their interest? For job security. Employees want job security. They don't want to leave. They don't want to be sacked anyhow. We have good condition of work. So what that is what employee was and managers want, and job satisfaction, career development, and relevant training. So that is what employees want. The shareholders, they are also a stakeholder. Shareholders are those people that bring money for the creation, or they are the real owners of the business. So shareholders themselves are stakeholders group.
Now, what is their interest? Their interest is to obtain a suitable return from their investment. So, shareholders, what they want is that they want a return from the money they invest in the company. So, shareholders are, are the ones in which wealth management is talking about. So, we can read it up. Now, another stakeholders are lenders. Lenders. Lenders, when a company borrows money, the lender or lenders are stakeholders. So those that lend money, they are also stakeholders. Now, lenders might be banks, investors in the company's bonds. So anybody that lend money to the company, anybody that give money to the company, they are lenders. So they also have an interest in the company. Well, the main concern of lenders is to protect their investment. So they want to protect their investment. If the if the company is heavily in debt, credit risk might be a problem. So, and the lenders might be concerned about the ability of the companies to meet its interest and principal repayment. So, lenders also their interest is in the company is for the company to meet up the interest, that's interest they will pay on the loan, and the principal and the principal, which is the repayment of the loan. So that is the objective of what lenders. Now, the government. Why government is a stakeholder? Government government is also has interest in the company, especially large companies, for varieties of reasons. The government regulates commercial and industrial activities. Therefore, it has an interest in companies as a regulator. So, government, apart from they have interest in the company as a regulator, so they regulate the company. So, for example, SEC now they are regulator of a listed company. So they are government agencies. So they are also government. Now, for governments, what their interest apart from as the regulator, they have their interest is used for tax purpose. Companies are also employers. One of the economic aims of government might be to achieve full employment. So government also wants companies to employ. So no country or no government of a country wants the unemployment rate to increase. So they want their citizens to gain jobs. Some companies are major suppliers to the government. Yes, some companies supply to government. So we have customers. Customers are also stakeholders. So what do they want? They want quality of product that should last certain number of years. So they want durability of product, a product or service that might meet consume customer needs. So that is what our customer need. That's why they are also stakeholders. Number six, suppliers, those that sells goods to you. They are also your stakeholders. So what is their interest? Regular order in return for reliable delivery and a good service. So they want you should regular order. You should regularly purchase from them. That is why they are also stakeholders. Provider of loan stock. So just similar to the one of lenders. Now the society as a whole, society is also stakeholders. So society they want to control pollution. Society does not want the company to keep emitting pollutions, carbon dioxide to the society. So society can be an hostile to the company. So that's why they are also stakeholders. Now, let's look at agency relationship. Agency. When we say financial management, because there are different between the owners. Because in financial management, we say the modern aim of a business is to maximize wealth. And this maximize wealth lead to controversy between the owners of the business, which is also called the agency relationship, because the owners of business are different from the managers. So there is always discrepancies in their interests. So one might affect the other one. So agency theory was developed by Jason and McLean in 1979, who defined agency relationship as a form of contract between a company's owners and its managers, where the owners appoint an agent called the managers to manage the company on their behalf. So what is the conflict? So what is the conflict? Ag- agency conflict. Agency conflict are different in the interest of the companies, in the company's owners and managers. The, they arise in several ways. So the conflict, what might lead to conflict? Moral hazard. A manager has an interest in receiving benefit from his or her position as a manager. That means the the manager, all they want is that, okay, they want to receive benefit for what they are offering. So they are not looking at the futuristic plan of the business. What they want is, okay, let's keep running day to day, and let them receive their salary. And that what the another thing is the effort level, because managers may work less hard than they work if they were the owners of the business. Yes, because there is also this word saying that as long as it's not my business, I can't kill myself for it. That is just it. The same thing happens to managers and the owners. So managers, if they are to be the owner of the business, they will give in their best to it. So that is what's called effort level. Earnings retention. The remuneration of directors and senior or managers is often related to the size of the company other than its profit. So earnings now, manager does not care the profit the company is making. As long as it's a big company, okay, it's a Dangote, is share, is ExxonMobil. So they are expecting big remuneration. They are not looking at the profit of that company. So if the company making profit, that is the interest of managers. Risk aversions. Executive directors and senior managers usually earn most of their income from the company they work for. They are therefore interested in the in the interested in the stability of the companies, because this will protect their job and their future income and their future income. So time horizon. Shareholders are concerned about the long-term financial perspective of their company. In contrast, managers might only be interested in the short term. So our next class will start from agency cost. We'll look at agency cost. We'll look at the three aspects of agency cost, which is a cost of monitoring, or the third, and the cost of bonding. We'll look at the problem. So with this, we'll come to the end of today's class. So we can continue from the agency course.